What if there was an investment portfolio that would grow in times of economic prosperity, resist recessions, shield you against inflation, and give you a built-in emergency fund, all in one? Well, that's exactly what American investment analyst Harry Browne was trying to do with his permanent portfolio. Let's break down what it is, how to build it, and look at how well it actually performs in reality. The permanent portfolio is like the Swiss Army knife of investment strategies. It aims to give you a bit of everything so you can survive all sorts of financial storms. The idea is to reduce your overall risk by spreading your money across different asset classes that each tend to perform well in different economic scenarios. This way, you can achieve a balance between growth, safety, and inflation protection. It's not about trying to maximize growth with this portfolio. It's about steady performance year in, year out. So how do you build it? The permanent portfolio is divided into 4 equal parts. 25% of this portfolio is in stocks. In Browne's original version, this meant domestic stocks, so US equities. These are your go-to when the economy is booming. It's like the turbocharged part of your portfolio. When things are going well, you need stocks to take advantage of those rising stock prices. Another 25% is allocated to bonds, originally long-term US Treasury bonds. These are your safety blanket. They tend to perform well during deflationary or recessionary periods when everybody needs some comfort after looking at the stock market. The next 25% is invested in gold or precious metals. Gold is there mostly as a hedge against inflation or economic uncertainty. And the final 25% is held in cash or cash equivalents like US Treasury bills. This is for liquidity and safety. It works as a buffer against short-term market volatility and can also double up as your emergency fund. In the UK, we could build this portfolio with something like these ETFs. I've chosen the cheapest available ETF for each asset class, swapped out the US stocks for all of the developed world, and replaced the US Treasury bonds with UK long-duration gilts. The cash can just go in whatever's the best high-interest savings account available at the time. So in theory, at least one of these asset classes should always perform well, regardless of the economic environment, and that means, hopefully, a stable return over the long term. But how well does this actually work in practice? Well, we can check that by looking at how the assets perform next to each other. And from that, we can see that stocks definitely do provide the most growth. Bonds provide less growth, but mostly manage to have a positive return when stocks do not. Gold usually has a positive return, even through periods of higher inflation as we hoped, with the exception of 2013 when there was an unusual gold crash. And cash is of course going to do better when interest rates are high, and worse when they're not, like in the period from 2008 to 2022. But to understand overall performance, we need to compare the permanent portfolio to a more traditional portfolio. Let's use a 60-40 stock-bond split, because that's a fairly common asset allocation. Here we see the permanent portfolio doesn't have as much growth, but does have a smoother ride compared to the more stock-heavy portfolio. With the 60-40 portfolio, your worst year had a 20% loss, but the permanent portfolio only lost 12%. But the average annual growth rate of the 60-40 portfolio is nearly 8%, and with the permanent portfolio, that drops to 6.67%. So that confirms the main appeal of the permanent portfolio is its stability and ability to preserve your capital across most economic scenarios. But of course, the price you pay for that is lower long-term returns because of the low allocation to stocks. After all, 75% of the permanent portfolio is allocated to defensive asset classes. This means the permanent portfolio is best suited to people who are very risk-averse or looking to mainly preserve and not grow their capital. Also note you do have to rebalance this portfolio once a year to maintain each asset class at its 25% allocation. If you don't want to bother with rebalancing, you could avoid it with a single fund portfolio instead. I talk about a few of those in this video.